I think let's just cut across to the big fund manager panel in the Morningstar conference.
Analysis, if your thought process, if your logic is right, eventually you will win.
Thank you so much, Prashant. Can we have Naren's presentation on screen, please? So, Naren, you can sit in. Yeah, that's fine. Okay. So, Naren, you've always loved the downtrodden or the beaten down. So, can you share your perspectives around?
Basically, I have divided the market into 4 cycles. I would call bust, then best, third is boom, and fourth is bubble. So the bust happened in 2002, 2008, 2013, where if you managed to invest in small caps, you got returns which were unbelievable. The best phase was 2003, 4, 5. You've seen 14, 15, 16. So those are best phases from an investor perspective. Now we've reached the boom phase. And so we are currently in a boom phase. When you have 20,000 crores of monthly inflows into mutual funds, we are in a boom phase. So we try to look at what people should do in a boom phase, because the bust and best phase is over and now we are in a boom phase. What came out very clearly was that people have to respect asset allocation. And in a boom phase, people normally stop looking at asset allocation and invest in the theme of the day. And if you go back to the 2007 cycle, what Prashant pointed out, people invested in infra. In 1999, people invested in tech and slowly stopped asset allocation. So I think we are in this phase of the market where wealth managers should not stop asset allocation and investors should not stop asset allocation. It's very evident at this point of time that equities have delivered better returns than any other asset class. But equities is not a risk-free asset class and do have periods of time when they show volatility. So I believe that one has to respect asset allocation, which means one has to invest in both debt and equity or invest in products which have debt and equity. So that's one clear learning from the past booms. 2006 was a clear boom. After that comes the bubble phase, and I think the bubble phase is the most irritating phase for all of us, because it's a phase where you have to cut risk. And cutting risk is never a pleasant period. So I shudder to think of that period, because in 2007 when we had a bubble, or 1999 when we had a bubble, it was not an easy period. So I believe that even this time it would be difficult. And in that phase, what you will have to do is just cut equities and reduce the risk in the portfolio. On paper, it looks very, very easy, because what you're doing is you're booking profit. But in practice, from my past experiences of watching 92, 94, 99, 2007, it's very difficult to actually cut risk in a big boom. And that's what people would have to do. So I believe that what are the other mistakes that happen in bubble? People decide that this is the only sector to focus on. So I would say one of the lessons that we learned from looking at the past bubbles is, if you avoid themes, you actually ensure that you have not made a big mistake. And when we looked at what turned out to be the best was investing in pure large cap and practicing asset allocation. These are the two things which work well. Why does pure large cap works well? Because at the end of the day, after a bubble, always there is a big fall, and in that big fall, mid and small caps have never done well, and it is large caps which have done well, because there are a lot of long-term investors, particularly in India. If you look at it, insurance has always been the biggest long-term investor. They tend to buy the large caps in that fall, and therefore large caps tend to be defensive. So I think clearly going forward, what we have been trying to do is invest in all our advertising in dynamic asset allocation category, because I think in a boom, that's the best category to invest in. And if people want to take risk, we think that pure large cap is the way. But I think what people shouldn't forget is that boom is the period where money can be collected in a big way. So while the best phase is over, the boom is the period where people can collect money, and investors will show 10% of their net worth to you in the bust phase. They will show 20 in a best phase. Now they'll show you 50%. In a bubble, they'll show you 100% of their net worth. So what happens is that expands your business. So the best time to do business is today, but the best asset class to invest in is actually to follow asset allocation. This is broadly what I have to comment.
Sure, thanks so much, Naren. So I think some interesting thoughts coming through. Before we get into a discussion, can we have so we had a poll asking, the advisors and investors that given the recent run-up in markets, what are their clients, how are they approaching equity investing? So if you could have the results of that up on stage. So some of the options are not clearly visible. Let me just read that out to you. So some of the large responses for SIPs clearly, which we've seen that trend. So systematic investing continues. Buying at dips, that's another trend. And asset allocation, the last option, which is about 28%. So clearly, I think there's a lot of investor interest, and as we're seeing flows increasing, the investors are increasingly looking at equities. So I want to just get a little more into this discussion about the risks that we could face at this point of time in terms of. So Prashant, you've been an early cycle investor, and with that comes. And you spoke about it, that you need to be patient with your investments because it might take some time to play out for the market to recognize that. So that adds a baggage of a little bit more volatility than you would hope for. How do you deal with that? One, and what are some of the risks that you see which could probably derail your thesis at this point of time? What could go wrong?
Can you hear me? Working? Okay. So last 10 years, the CAGR of the index has been only 5-6%. So that is point number one. So there is this notion that markets are expensive. I somehow feel quite differently. If in an economy where the GDP has grown, nominal GDP has grown 12 to 16%, and index has grown only 6% for 10 long years, actually India's market cap to GDP is at very attractive levels. That is point number one. So fundamentally, I think I am quite optimistic about the markets. And of course, see, you said you invest early in a cycle, and I would say maybe I have a value bias. I'm not saying for all my colleagues, but I personally, maybe I have a value bias, and value is available only when a sector is passing through some pain point. And if you believe that pain will go away and performance will improve, over time it turns out to be a good investment. And you can go back and see, if you were early in the cycle, the rewards have come a bit late, but they have been fabulous. If you bought capital goods, banks, metals in 2000, they went up 20-30 times. If you bought oil companies when they were burdened with the subsidies, they've gone up 5 to 10x. And someone who has bought them in last few years, you made little money. So the real, I think, returns come if you buy a business when it is trading much below its intrinsic values. And that typically happens only when there are some challenges either in the environment or in the business. So I feel again that we have faced some challenges, and things are likely to improve going forward. And you asked about risks. See, I think the economy, to my mind, is really well placed, and I am not trying to be overly bullish, but I genuinely am not able to place too many risks to the local economy. If something happens in Korea, if something goes wrong in geopolitics somewhere, the markets can always correct. And we have seen Indian markets have a high correlation to events outside India. But as far as the economy is concerned, as far as I think going forward the profit growth is concerned, I would be quite optimistic.
So just a quick add-on question to that, Prashant. So you mentioned about the market cap to GDP being still lower than what we've been at. Do you think it could possibly be the factor that a large part of the GDP now, increasingly more, is actually coming from the unlisted space, and that's why it's not being captured in that? And as they IPO, again, valuations could be a little bit of a challenge.
So I don't know. I mean, I have not come across any studies which suggest that. I'm open to looking at a study like that. But what I realize is a lot of us nowadays, many of us are just forming opinions based on impressions and not based on any evidence or research. So people say jobless growth. Now, fact of the matter is there is hardly any job statistics in India.
Right.
So I don't think what you are saying is. I mean, I have not come to across any evidence which suggests that. And what is happening is market cap to GDP is low simply because few sectors have very low levels of profitability.